Hey folks, I hope you're doing fine. I'm Simo from Investment Research, and today I'll break down my analysis for SoFi stock on November 1st, 2025 before market open next week. Now, if you've been following the fintech space, you know SoFi has been one of the most interesting stories in this sector, and after their recent Q3 earnings report that came out just a few days ago, there's a lot to unpack here. So what's really happening with this company and whether it makes sense for retail investors at current levels to still buy more or hold positions at this price action level. First, let me give you the current situation. SoFi closed at $29.03 on November 1st, which actually represents a 6% decline from the previous session. Now, before you get concerned about that pullback, you need to understand the broader context here. This stock has been on an absolute tear this year. We're looking at gains of 106% year to date, and the stock recently touched its all-time high of $30.30 back in September 2025. So this is a stock that's clearly got momentum behind it. And the question is whether that momentum is justified by the fundamentals. Let me walk you through what happened in quarter 3, because this is really where the story gets interesting. SoFi reported record adjusted net revenue of $950 million, which represents 38% year-over-year growth. That's not just good. That's exceptional growth for a company at this scale. The company beat analyst expectations across the board with adjusted earnings per share of 10 cents versus the consensus estimate of 8 cents and 33 hundredths. They also posted adjusted EBITDA of $277 million with a 29% margin, which was up nearly 50% year over year. These are the kind of numbers that get institutional investors excited, and you can see why the stock has performed so well. Now, what's driving this performance? This is where my analysis gets really important because you need to understand the business model transformation that's happening here. SoFi started as a student loan refinancing company, and many investors still think of them that way. But that's not what SoFi is anymore. The company has evolved into a comprehensive digital financial services platform, and the numbers prove it. Their financial services and technology platform segments now generate 56% of total revenue, up from being a much smaller portion of the business just a couple of years ago. Fee-based revenue hit a record $409 million in Q3, up 50% year over year, and now represents 43% of their total adjusted net revenue. This is a massive shift in their business mix, and it's extremely positive from a valuation perspective because fee-based revenue is much more stable and predictable than interest-based lending revenue. Let me break down the segment performance because this is crucial for understanding where the value is being created. The financial services segment, which includes products like SoFi Money, SoFi Invest, and their credit card offerings, saw revenue surge 76% year over year to approximately $216 million. The contribution margin in this segment improved to 54% from 42% in the prior year quarter. This is capital light, high margin business that scales beautifully. The technology platform segment, which includes Galileo and Technisys, continues to provide steady recurring revenue from white label banking infrastructure services to other fintech companies. The lending segment, while still important, grew at a slower 23% pace to $481 million, but they're seeing excellent credit performance with personal loan net charge-offs declining 23 basis points to 2.60%. From a member growth perspective, SoFi added a record 905,000 new members in Q3, bringing total membership to 12.6 million, up 35% year over year. They also added 1.4 million new products, accelerating product growth to 36% year over year for a total of 18.6 million products. What's particularly impressive here is the cross-buy rate hit 40%, which means 40% of new products are being opened by existing members. This is the flywheel effect you want to see in a platform business. Their unaided brand awareness reached 9.1% in Q3, which shows significant room for growth considering they're only capturing a small fraction of their addressable market. Now let's talk about the guidance, because this is where management is really showing confidence. They raised their full year 2025 outlook significantly. The company now expects adjusted net revenue of approximately $3.54 billion, which represents 35% growth. They increased adjusted EPS guidance to 37 cents from 31 cents previously. They're projecting adjusted EBITDA of approximately $1.035 billion and net income of approximately $455 million. They expect to add at least 3.5 million new members for the full year. These are strong numbers, and the fact that management is raising guidance after delivering such a strong Q3 tells me they're seeing continued momentum in the business. From a valuation perspective, SoFi is currently trading at a market capitalization of approximately $36.6 billion. The stock has a beta of 2.35, which means it's significantly more volatile than the broader market. So retail investors need to understand that this is not a low-risk investment. However, when you look at the company's ability to consistently exceed what they call the Rule of 40, which is the sum of revenue growth plus EBITDA margin, they've averaged a score of 58% since going public. This puts them in rare company among both fintech and traditional financial institutions. The analyst community has been adjusting their price targets following the third quarter results. We've seen multiple firms raise their targets, with estimates ranging from $26 at JP Morgan with a neutral rating to $38 at Mizuho and Needham at $36. Goldman Sachs raised their target to $27, and UBS raised theirs to $27.50. The consensus appears to be forming around the mid to high 20s to mid 30s range, which suggests the street sees some upside from current levels, but opinions are mixed on how much. Now, let me talk about the risks, because this is where institutional analysis differs from what you typically hear. First, the stock has become extremely volatile with 42 moves greater than 5% over the last year. The recent 6% pullback is part of that pattern. Second, there's execution risk around their expansion into new areas like crypto, blockchain, and AI-powered financial products. Third, the macroeconomic environment still matters. While lower interest rates could benefit their lending business by increasing demand for mortgages and personal loans, a recession could impact credit quality. Fourth, insider activity shows 9 insider transactions over the past 6 months, all of which were sales with 0 purchases. That's something to pay attention to, though it doesn't necessarily indicate a problem. The competitive landscape is also heating up. Traditional banks are investing heavily in digital capabilities, and other fintechs are expanding their product suites. SoFi's advantage right now is the breadth of their platform and their execution, but they need to maintain that edge. Their credit performance has been excellent, with borrowers having weighted average income of $157,000 and FICO scores of 745 for personal loans and 773 for student loans, but they need to maintain these high quality standards as they grow. Looking at the institutional ownership data, we're seeing mixed signals. Some major institutions like Valoridge Investment Management added nearly 8 million shares in Q2, increasing their position by 92%. Bank of America added 7.5 million shares, up 65%. On the flip side, Susquehanna International Group reduced their position by 71%, selling nearly 7 million shares. And Cubase Research and Technologies completely exited their 6.3 million share position. This tells me that there's disagreement among institutional investors about the valuation at these levels. So here's my assessment for retail investors. SoFi has executed exceptionally well on transitioning from a lending-focused company to a diversified financial services platform. The Q3 results demonstrate strong momentum across all key metrics. The business model is becoming more capital light and predictable. Management has shown the ability to deliver on guidance and raise expectations, and the addressable market remains enormous with only 9% brand awareness. However, at 106% gains year to date and trading near all-time highs, the stock has priced in a lot of the good news. The valuation is no longer cheap and you're paying for growth and execution. For investors who don't own the stock, I would wait for a better entry point. The 6% pullback we saw on November 1st could be the beginning of a larger consolidation, especially after such a strong run. I'd be looking to establish positions in the $24 to $26 range if we get a broader market pullback. For existing shareholders, I think holding makes sense given the fundamental trajectory, but I would consider taking some profits if the stock approaches the $32 to $35 range in the near term. Use any strength to trim positions and lock in gains. The long-term thesis remains intact. SoFi is building what could become one of the dominant digital financial platforms in the United States. Their focus on high-income, high-credit quality customers gives them a moat in the premium segment of the market. The expansion into fee-based revenue and technology platform services is creating a more valuable business model, but timing matters in investing, and after a 106% run, patience is warranted for new money. My rating is hold for existing positions and wait for better entry for new positions. The target price range over the next 12 months is $28 to $34. Assuming continued execution on their growth plans and no major deterioration in the macro environment. Key things to watch going forward include Q4 results in early 2026 to confirm the guidance trajectory, credit quality metrics, especially if economic conditions weaken, progress on their expansion into crypto and AI-powered services, and brand awareness growth as they scale marketing efforts. That's my analysis on SoFi stock as of November 1st, 2025. This is a high-quality company that's executing well, but the valuation reflects a lot of that execution already. As always, do your own research, understand your risk tolerance, and never invest more than you can afford to lose, especially in volatile growth stocks like this one. Thanks for watching, and I'll see you in the next analysis.